The stock market, a place so vibrant, beautiful, and obscenely diverse, is but a platform where millions and millions of facts, numbers, data, and myths collide to produce winners and losers. But before understanding the whole thing, we need to have a clear picture of the smallest element present here. Want to know how? Check out the whole video.
What's up everyone, this is Rushil from Serene and welcome back to a brand new video from Serene. So this is our second video on the basics of the stock market. So in the beginning of this video I told you that before looking at the whole market we need to analyze one small point of it. So by one small point of it, what do I mean? You know what I mean, right? It's one stock. So we are not just going to look at the stock from when it is listed, but from when it is born, from the day it started its operations. So this will be the first one and we are going to cover up the whole process in depth, and this one will be on equity financing, mostly on equity share capital, etc. You'll get to know it as we proceed, and we're going to waste no time and we're going to start this instant. Okay, so we start with our own personal company, our own virtual company. So it was started by two brothers, Mukesh and Anil. Not these two. Other Mukesh and Anil. So the name of this company is Mango Shower, and they make biscuits, mango flavored biscuits, because that was the most unique thing I could think of. Thank you. So before starting any business, the standard thing which you require, the initial thing which you require is capital. Now capital sometimes is quite a misunderstood term. So to give you a standard definition of capital, let's begin. I'd like to read this out from Investopedia so you can see this on the screen. So what is capital? Capital is a term for financial assets that is funds held in deposit accounts and funds obtained from special financing resources. Capital can also be associated with capital assets of a company that requires significant amounts of capital to finance or expand. So in simple terms, capital before starting a business, okay, before a business is started, capital is the initial thing, is the initial base which you require to start that business. So capital can be money. Now pay attention to what I'm saying very nicely. Capital can be money or capital can be assets. So when these two guys started the company for Mango Showers, the initial thing which they required would be obviously land, would be the machines, would be the people to work to create those biscuits, then some amount of raw materials, obviously that's the most important thing, and obviously the recipe, because without the recipe there would be no biscuits, right? So for them, for starting the business, capital can either be money or it can be the land, maybe. For example, if they inherited it from their family, they don't have to pay for it, but it is their capital, right? It is the starting thing which they require, correct? It is a capital asset. But in this case, to make things simpler, we'll think of it that both of them put an equal amount of money inside the company. So we'll say that both of them invested 5 lakh rupees inside the company, which is 50,000 shares at rupees 10 each. Now what do I mean by this statement? So now what they did, now an important thing comes to play. Is money capital? So now you can again see on your screen a beautiful definition from Investopedia, that is money a form of capital. So again, let me read this out to you. Capital versus money. At its core, capital is money. However, for financial and business purposes, capital is typically viewed from an operational and investment perspective, which means that money is not exactly capital, because money is a tool which is used for buying capital. To make it very simple for you, now let me put this, whatever I said a few minutes back, whatever you're seeing on the screen right now, let me put this in a different way. What they did is that they paid money to somebody. Each of them paid 5 lakhs to somebody. To whom? To the company. Company is a person. Assume company to be a person. They paid 5 lakh to the company, and in return for that money, they paid money. Okay, they paid money to the company, to Mr. Mango Shower. They paid 5 lakh, and in return, what they got? They got capital. And what is that capital called? Shares or equity share capital. So that forms the basis of our lecture today. So money is a tool, as we just saw right now, for buying capital. Now this is the case for equity capital. I'll talk about equity in a few seconds. So this is for equity capital. But they can use this money also, some other form of money. So this money to buy capital assets like building. They give money, they get the building. They give money, they get the raw materials. They pay the money, they get the laborers. Right? So money is not essentially capital. Now again, I'm showing you another term, an important definition from Forbes. Capital comprises the physical and non-physical assets used in making goods and services. Money is primarily a means of exchanging goods from one buyer to a seller. Capital is measured in monetary terms. Since money buys physical assets, capital is often thought of as money. But strictly speaking, there are different concepts. So money is a tool for buying capital, but not capital. Obviously, money is required for buying capital. Money is the primary thing for capital, but it is not capital. I hope you got me. So now what they did, they put in 5 lakh each, right? They put in 5 lakh each, and how did they represent it? They gave 5 lakh to the company, and the company gave them shares, 50,000 shares. 50,000 shares of rupees 10 each. Now what is rupees 10 each? Rupees 10 each is the nominal value of the shares, so the face value of the shares, or the par value of the shares. What is this? This is the value or the dollar value which is associated with shares when they are issued at the time of issuing. Now what is happening? The shares are being issued. They are being created out of thin air, right? They are being created out of thin air by whom? By these people, by Mr. Amit and Mr. Anil and Mr. Mukesh. So they created shares and they paid money for those shares and they got the shares, right? Yes. So now they got equity stake in their own company. Now comes the term equity. So equity means ownership in its plain and simple form. What they did was they gave money for ownership, right? By purchasing shares, they bought ownership in the company. And by buying ownership, it means that they both have now, because the ownership is 50-50%, right? 5 lakh, 50%. So now they have bought an equal ownership, which means they have an equal right over the assets of the company, an equal right over the earnings of the company, and an equal right over the decision making of the company, right? So now they issued shares of rupees 10 each. So during the time of issuance of shares, every share is associated with some value. So it means that to put it in plain terms, all these shares are worth something, and each share is worth rupees 10. That is the plain definition of it. So these are issued at rupees 10 each. They can put it any number. They can put any number to these. They are going to invest 5 lakh only. It doesn't matter what number they put, but it is generally a small number, 5 rupees, 10 rupees for public companies. But we'll talk about that later, why it's a small number. It's also, it's an interesting thing to know why it's a small number. But now we'll assume that it was rupees 10 each. Every share was worth rupees 10. So now each invested 5 lakh and they bought 50,000 shares at rupees 10. So 50,000 into 10 is 5 lakh. So that is understood. So now we'll try to understand some terms associated with this. So now 50,000 is number of shares and rupees 10 is the face value of the shares. Now what is the issued capital? Now issued capital is a very important term right here. So issued capital is the total amount of capital which has been issued to the investors and the capital at the rate of the nominal value of the shares. So now that is the sum of the total capital which was invested. So how much does each person contribute? It is 50 into 10, but which is 5 lakh upon 5 lakh or plus 5 lakh, which is 10 lakh. So rupees 10 lakh is the issued capital up till now. Till now, rupees 10 lakh is the issued capital. Now, just to give you some extra information, what are the different types of capital? Now, this is not extra actually, this is required. So, I'm going to make a separate video on this immediately after a few days. So, the 4 types of capital are equity capital, debt capital, trading capital, and working capital. So, we're going to discuss them all in length. There are also mezzanine capital, which is a combination of equity and debt capital, but I'll talk about it later. So, now, these shares are common shares. There's a difference between common and preferred shares, but that again is a different concept. We'll talk about it later. So rupees 10, 50,000, clear. Issued capital is how much? Rupees 10 lakh, very clear. What is the ownership? Again, we'll put up ownership bracket here. Ownership is 50-50% for both Anil and Mukesh, right? So now what happens is another investor comes into the company, but before that, the company starts its operations. Now the capital was there. Rupees 10 lakh capital was there. But what to do with the capital? That capital is just lying with Mr. What was his name? Mango Shower, with the company, right? So it was lying with Mango Shower. It was lying freely, that capital. So the capital has to be put to use. Obviously, that's why capital was there. So with this capital, we'll assume that they bought some buildings, etc. We're going to discuss operations in length also. But just to give you a brief, they bought a building, we'll assume, a small space, not a building, bought a small space, and they bought some machines and they hired some laborers, etc., etc. So they started operations. And in the initial stage, the company soared off. Like in the area where they started, it was like popular and everybody loved their biscuits. So we just went a bit forward in time, skipping all the process in the middle. And it just went ahead, and the whole area, the city, the locality, whatever, the store became extremely popular. The recipe became super hit. So now, what happened is that a small investor came to them. Small guy, like itna bada nahi. Like he's a neighbor and he's that chacha ji, etc. He came there, I want to invest 20 lakh. Okay, 20 lakh is a big amount. We'll take 5 lakh. मेरे को 5 lakh invest करना है. So 5 lakh he wants to invest. Now, another concept. Authorized shares or authorized share capital. So now, Anil and Mukesh, when they started the company, when they issued the shares, they didn't just issue 10 shares. 10 lakh. 1 lakh shares. 50,000 plus 50,000, 1 lakh. They did just issue 1 lakh shares. How much they issued was, we'll assume 20 lakh shares. And those 20 lakh shares comprise the authorized capital, or the amount of shares which they are entitled to issue, and the maximum amount of shares. And they can't issue any more shares further ahead of those number of shares. They can't issue anything ahead of 20 lakh. But okay, that's just on paper. They can increase it later on if they want. Obviously, they can increase it. So now, 20 lakh shares was the authorized capital. But authorized capital is a rupee figure. So number of shares equal to rupees, that comparison can't be made. So 20 lakh into 10, because nominal value, face value of shares is 10 rupees. So 20 lakh into 10, which is 2 crore rupees, was the authorized share capital. Right? That much amount of capital they are, at face value, they are allowed to issue. Maximum capital. Obviously, they can increase it later on. Okay? So that is authorized share capital. Please keep that in mind. So now one investor comes, 5 lakh I want to invest. They say, okay. They check on the authorized share capital. मतलब हमारे पास 20 lakh shares है, we have 20 lakh shares. Out of those 1 lakh we already have with us. So 20 minus 1, 19 lakh shares are still remaining. They have not been issued to any investor. Pay attention to the words. They have been created, but they have not been given to any investor. They are just lying there. Out of those 19 lakh shares, because 1 lakh shares are already owned by Mr. Mukesh and Anil. So they say that, okay, you want to invest 5 lakh rupees? Okay, so we'll decide how much amount we are willing to give to you. So now, what they do is that they can issue, they can give the shares to him, but how many shares and at what price? Now, this is a very interesting thing. Now, this is decided by valuation. Now, they can't give him for whatever X number of shares at rupees 10 at the nominal value. Because what would that mean? It means that there is no increment in the value of the shares. It means that whatever money they had put in, there is no increase in value for themselves. They had invested 5 lakh, right? That was an investment for them. Each of them had invested 5 lakh. And value of each share which they own was rupees 10. But now if they sell the shares at the same price, it means that there is no capital appreciation for them, for their shares. What do they earn, right? So for that, obviously there is an increase in the value of the shares, because the company has started operations, the company has grown, the company has started to earn, which also means that since the earnings of the company is more, the company has started to generate more revenue, the company is pricier to invest, because the most amount of capital, or the highest risk which was taken, was by the starting shareholders, right? At rupees 10 each. They were the ones who had put it the starting amount of money. So obviously the ones who come in later, they are entitled to pay a premium or a greater price to the face value in order to come into the business, because it is profitable. In order to enjoy the profits, they have to pay an extra price. That is the market value of the shares, right? So market value also I'll talk about later, but just keep in mind this, that in order to take part in this earning story, in this big growth company, they have to pay a little bit extra amount, whatever it is. That extra amount in contrast to what the owners had paid. I hope this is clear, very crystal clear. So our new investor, we call him Mr. Ronald. So as we discussed, he wants to invest 5 lakh rupees. So now there are two scenarios which can happen. either they both the initial shareholders. Okay, to tell you, initial shareholders are called promoters. This term you're gonna come across a lot of times while studying the annual reports. They're called the promoters of the company or the founders of the company. But in the annual reports of the company, they are called promoters. So please remember this word. So now Mr. Ronald wants to invest 5 lakhs. So alternate scenarios, we'll check out 2 different scenarios. So they say that okay, we can give you 50,000 shares at rupees 10 each, which shows that there is no appreciation in the shares, right? We're just selling you all the shares at the market value, at the face value. So now we'll have a close look at the ownership. Now, how does ownership get affected? So ownership, the formula of ownership is the total number of shares owned by any person upon the total number of shares, total number of issued shares, correct? Not the authorized shares, but the issued shares. So the total number of issued shares before this investor came in was how much? Was 50 plus 50, which is 1 lakh. And now, if they give him 50,000 shares, the total number of shares increased to 1.5 lakh, right? 1 lakh plus 50,000, which is 1.5 lakh. So now his ownership, Mr. Ronald's ownership, now his ownership is 33%, correct? Because 50,000 upon 1.5 lakh is 33%, and the ownership of Mr. Anil and Mukesh, it changes to 33%. It decreases to 33% from 50%. This is scenario number 1. Keep this in your mind. Now scenario 2 is, this is the smarter scenario. What Anil and Mukesh can do is that they say, okay, we'll not give you 50,000 shares at 10 each, but we'll give you 25,000 shares at rupees 20 each. What does that mean? They're selling him every share at double the face value. So the shares have appreciated. They say that okay, we are going to charge you rupees 10 premium on every share. So now the total number of shares, like the total number of issued shares, is 50k plus 50k plus 25k, because they're going to give him 25,000, right? So 50 plus 50, 1 lakh plus 25, 1 lakh 25,000. So now, what is the ownership of Mr. Ronald? Number of shares Mr. Ronald owns is 25,000 upon how much? 1.25 lakh, right? So his ownership right now is 20%, correct? And the ownership of Mr. Mukesh and Anil is 40%. So remember in the last scenario that ownership was reduced to 33%, which is a 17% drop in ownership, correct? But now the drop in ownership is only 10%. And also the shares have appreciated. The value of the share is not 10 rupees now, it is 20 rupees now. And they can sell it in the open market for 20 rupees, which means they have doubled their, they've got double returns on their investment. So both sides, they've got a great advantage. So that is what they do. They give them 25,000 shares at 20 each. But obviously this process has a lot of negotiations. Even when the company is listed, gets listed, if it wants to have, if it wants to take in big investors, or even if it wants to go public, the price at which it goes public, it also depends a lot on demand, negotiations between the two parties. And we'll just assume that the negotiations come out around rupees 20. So that was our first video. But in this video, we just talked about one investor coming in, one new investor. And the topics we discussed were issued capital. I'm going to explain it again if you still didn't understand it in the next video. Authorized capital. And I guess that was it. And some amount of face value also we discussed. So in the next one, we'll talk about paid up equity share capital, authorized share capital again, issued share capital, and one more form of share capital, which is over and above the equity share capital, which I'm going to talk about in the next video, which is gonna come soon. So I hope you understood this video, and I hope you like the concept, and I hope you're getting it. So thank you for watching the video. Jai Hind, Jai Maharashtra.